Welcome. How's it going, everyone?
Hey, hey,
Sweet. What's up, Zach? How's it going, man?
good. How are you? Can you hear me?
Yeah,
Cool.
sweet. Let me just get our layout fixed here. Let's see. All right, I think this should do pretty well. Welcome, everyone. Glad to have you guys in here. We're going to run over a quick wheeling workshop today. We've got Zach here, expert option seller, to tune in and give us some feedback as we go over today's content and presentation. We'll hop right into it. Feel free to ask questions as we go, or you can save them for the end. Zach's going to also chime in and give some great stuff here for you guys. And then also at the end, if we have time, we can take a look at some heat maps or charts, things like that. But let's hop right into it. Just kind of going over a few different things today, like I'd put in Discord. I'm not going to read all these out to you. We're just going to go right into it to save time. Starting with some mindsets and foundations for you. So the foundation of option success. This is a good graphic. I like using this one. Most thing to get out of this graphic is coming up with a trading plan and sticking to it. We'll kind of dive into a few different concepts and things here as we go along today. I know Zach probably could tie up in this one and talk about it, but I'd like to emphasize that you're trading as a business, not a hobby. Setting clear rules, follow the said rules, and learning from your data. Uh, Zach, you got anything to say about this?
Yeah, hugely important. Couldn't agree more. I do own a business, and boy, it's like if we never had any policies, and policies and processes, right? And those are really boring words to the options traders out there that are wanting to treat options like lottery tickets. And I think, we all know how most people who play the lottery end up doing in the lottery is not that great. So couldn't agree more. I mean, policies and processes can be transformative for a business, and that's how you ratchet things up. And yeah, couldn't agree more. I mean, even just yesterday, really quick, I won't derail us, but had some folks saying, "Man, I've learned some huge lessons. They've learned some huge lessons in 2026. Things that worked in 2025 just will not work in the long run, and we want to be doing things that will work in the long run." So certain names or certain types of names, leverage tickers, things like that. Just setting rules like, hey, not gonna trade those anymore, or not gonna use naked puts anymore. Not gonna use naked calls anymore. Whatever your rule. I'm not trying to tell you your rules, but whatever rules work for you, and then you can stick to them, right? And not to feel like you're in a straitjacket, but to feel empowered to really explode in the right direction going forward. So, okay, I'll stop yapping. I'll hand the talking stick back to you here.
Yeah, that's all great stuff there. Absolutely. So goal setting and reverse engineering results. I like to start with this question, especially with our beginners or some more intermediate option sellers, is how much money do you need to make weekly? You got to set that goal up and kind of reverse engineer from there. That's going to give you a good starting point of how much capital you're going to shoot to stack up to collect to start deploying your option selling strategy, um, things like that. And then also just stacking the small wins. As we can see over time, I'm sure everyone in here's ran some sort of compounding interest calculator, but it's truly some really crazy results, even when we're stacking those small wins. as the gurus on X would say, picking up pennies in front of a steamroller. Um, that's what they say against covered calls, which I don't always agree on. But anyways, we'll move on here. Avoiding shiny object syndrome, another big thing with option sellers. It might be that new ticker that's just got crazy volatility, crazy premiums, things like that. I don't want to throw hate on a beaten soldier, but I think a good example of shiny object syndrome, maybe over the past 12 months, would be HIMS. As we could see, um, maybe that was one where a lot of people got burnt when it was up there in the 50s selling options on HIMS, and you see it today down at 15 bucks. Not saying it's a bad company, but just saying at the right valuations and prices that I think a lot of people kind of got into a shiny object syndrome with HIMS. Some of this stuff is we're going to kind of skip over, but I want to just touch on this slide a little bit, um, especially for the beginners. Emphasizing this is a journey, it's not a sprint or a marathon. So, really, I mean, from day one, when you start selling options, it could take 3 to 5 years to really get that consistency down. And I know, Zach, you could probably comment on this because I think you're kind of falling into that window. Um, but I like to just run a quick exercise, and this kind of sheet that's on the screen here has some good questions on it, um, of just kind of going through, do you have a trading plan? How many hours per week will you dedicate to trading? And maybe it's not trading, maybe at this point you're a beginner and you just want to learn the craft. So it could be research, reading about different strategies. The next question on here is how will you track your trades? We'll kind of take a look at some of that stuff later. There's a lot of different options, whether you're a pen and paper guy, a spreadsheet, you've got some software, you don't track them at all. I would recommend that you track them at least in some form. And then we can take a look at a few things later with tracking. And then these are just kind of some more generic questions, but some motivational stuff. Why would consistent options income change your life? And then kind of a financial goals worksheet of your goal, what's your target date you're going to complete it, why it matters, and then monthly cash flow needed. And that would be more trying to aim towards escaping your job as an option seller, which I know a lot of us aren't at that point. But anyways, like, you got anything to add? I know you're kind of in this 3 to 5 year slot.
Yeah, absolutely. I mean, a lot of the things you're saying are causing me to think about, really good things here. What one thing is, for me, I, being someone who owns their own business, you don't really have a pension. You don't have someone who's setting up retirement for you. So I needed to do that myself. And initially was a gold and silver bug, and to a degree, actually, that worked out pretty well. But eventually got into ETFs, eventually got into stocks and crypto, and then options. And I think the longer you're in, the more you'll finally see, like, okay, you might like 5 strategies, 10 strategies. You might be like, I want to try like every option strategy. If you're trying to provide yourself that income, like what Hertz is saying, you're gonna have to figure out something if you're gonna do this. So I and Hertzy really like the wheel strategy in particular because that has a lot of longevity. 3 to 5 years. If you're sitting there playing options like lottery tickets, well, you're probably not going to last 3 or 5 years. And you said it earlier, picking up pennies in front of a steamroller. Well, some option strategies absolutely feel like that. I haven't heard that about covered calls, but I'm sure some folks would say that. But I absolutely think about that with, I for a while was selling spreads, daily spreads, working with futures, just selling the E-minis and trying to do zero DTE, just picking a high up or high, way low strike and hoping that you get there or hoping that it doesn't get there. And boy, that is the amount of stress that was bringing me, and you might make big money in one day, you might lose big money the next day. Like I was getting about 100 gray hairs a day doing that, and that's not going to work. So 3 to 5 years, I think this is why Hertzie and I like the wheel strategy. We're in super bloody times right now. Well, I mean, unless you're in defensive stocks. Um, Guess what? The wheel strategy still works. As long as you don't have like that last slide, Hertzie was talking about hymns. And I wheeled hymns for a little bit. Definitely took a little bit of damage on that. Chased a shiny object. But the as long as that's not your go-to, if you're actually wheeling with names like Hertzie does with Rocket Lab, he loves Rocket Lab, and I actually kind of like it too. Thanks to him actually. But if you can just stick to wheeling names that you do like, your absolute worst case scenario punishment would be that you have to buy shares, and you get paid to buy shares, and at a price that is a very hopefully a good price. Hopefully that's the way you structured your wheel. If so, that's a great punishment, and boy, what a wonderful thing. So, just a few thoughts on those last couple of slides. I'll hand the talking stick back to you here.
Absolutely. Thanks, Zach. That's all great stuff. And I sure do love my Rocket Lab. So I appreciate the shout out there. So let's kind of went over some mindset and foundations there, guys. We're going to get a little bit more into the meat and potatoes here, talking about options basics. And like I said, this is for beginners, but I think anyone can really find some value in here, just kind of going back over the basics. So we'll get right into it. So we'll talk about fundamentals of options. I'm not going to read verbatim off the slide here, but these are some really good textbook definitions. And I would just like to point out here that a stock option is a contract, essentially, which will give the buyer the right to buy or sell a stock at a specific price, also known as the strike price, on or before the expiration date. So that option buyer is the one that is essentially buying their lottery ticket. They're paying a premium upfront for the right, and the option seller or the writer of the contract is collecting that premium and taking on the obligation to fulfill that contract. And if you guys have questions as we go along, throw them in the chat. If not, we'll take some questions at the end. I know a lot of people probably aren't tuning in live, but hopefully you can go back and watch this as it will be recorded. Some key terms that you might hear us talking about within the option sellers hangout community: intrinsic value. A basic definition is going to be the portion of the premium that is in the money. So you've got some calculations and equations here if you want to look at intrinsic value. Extrinsic value is going to be more of the time value, the portion of the premium beyond intrinsic value, which decays over time. That's going to be that theta working for you. And that next thing that we see is theta, which is the loss of the option value as expiration approaches, that time decay. A couple other things that are kind of basic, but I like to throw them in here. In the money, the option has intrinsic value. It's in the money. At the money, the stock price equals the strike price, and then out of the money, the option would have no intrinsic value. Go over some Greeks here. Biggest one is delta and theta, and then we've got some of the other ones too that some people will use. As a beginner, I would fully just focus on delta and theta, honestly. Delta is measuring how much the option price changes with a $1 move in the underlying asset. And then obviously our good old best friend theta is measuring the time decay, and that's going to see how much the option price decreases per day as expiration approaches.
That is one of my favorite words right there.
Yep, absolutely. And then this is very more advanced stuff, but I'd like to just throw this in here if we've got some more advanced people joining us today. A good question was brought up recently within the community talking about theta and how that is built in over the weekends. Was it priced in? Is it not priced in? And from the sounds of it, it's completely priced in. Zach, I think, is that what we came into?
Yeah, and I don't want to fumble this up, but it sounded like sources, the best sources that we could find were saying something to the degree of it doesn't continue through the weekend as it does through the week. However, you it that takes place more on, I think, the end of Friday and the beginning of Monday or whatever the next trading day is. So you still get the effect of the weekend days, but I think they do it like that. I hear uh, from TJ the Wheel Deal. He was saying that it's like that because otherwise people could cheat the system and just open up. Let's say you have $10 million to play with, you can just open up on Friday night, or excuse me, Friday at 3:50 p.m. Eastern, all these sold positions, and then close them out at like 9:31 on Monday.
Right.
Just to drink in the theta, as long as there's no black swan event, then you're okay. And if there is, if you did it cash secured puts, you're actually still okay. So
Yeah,
I think
wouldn't
that's the
that be
reason.
awesome?
Yeah. So
Anyways, so a little more advanced here. I don't want to lose everyone here, especially if they're brand new, but let's talk a little bit about Gamma, Vega, and Rho. These I wouldn't worry about too much, especially as a beginner. I personally don't use them much at all, but Gamma is going to measure how much delta changes for a $1 move in the underlying. Vega measures sensitivity to changes in the implied volatility, which implied volatility is something I would definitely be looking at as a beginner. And then Rho is measuring sensitivity to interest rate changes, which is one that I never use. Let's talk a little bit about premiums collected versus captured. So a lot of times you will see in the community we're entering these trades. I like the I'll throw Lion under the bus here. He's picking up $10 for a Subway sandwich. I love that movement he's got going on right now in the community. Just realize that when we all say, okay, well, we collected $100 in premium or $10 in premium, that's an unrealized collection essentially until we would close out or that trade would expire. And then at that point, the premium would be captured or realized. And I just like to list this formula here. That is how you would calculate your annualized uh, rate of return on premiums when you factor in days to expiration. So let's get into the wheel strategy. So it's kind of the main thing that you're seeing a lot of us running within the community. So the wheel strategy, as complicated as it might seem, it's a pretty simple concept. So I would like to start with the emphasis on focusing on stocks you want to own. Specifically for like 1 to 2 years would be ideal. I wouldn't suggest wheeling anything that you say maybe I want to just own for the next quarter. Um, I would like to think a little bit more down the road, keep your eyes kind of down towards the end of the runway. But anyways, essentially, to initiate the wheel strategy, you're going to sell a put option, so a cash secured put. At that point, you're going to come expiration day, you're going to be either assigned them the shares or you won't be assigned the shares. And you can, if you're not assigned the shares, you can go right back up and start by selling another put option. Well, eventually, you're going to be assigned the shares most likely. Take assignment of the shares and you can start selling covered calls, ideally above your cost basis on the shares. And it's kind of the same thing at the bottom of the wheel. Eventually, you're going to just keep selling covered calls until those shares are taken away from you and you're forced to sell them, which you'll essentially start right back up at the top and start selling puts on it again. And this doesn't have to be in a perfect order. You could be selling covered calls at the same time selling cash secured puts. And that's kind of where it gets a little bit more muddy when it comes to everyone's strategy and how everyone has different preferences. So let's talk a little bit about selling a cash secured put. So with a cash secured put, you're putting up the collateral to control 100 shares at the strike price, and you will be collecting a premium upfront as income. So in this example I have highlighted on the screen, we're selling a put on TSOL at a $9.50 strike. So we're putting up $950 and we will be collecting $53 in premium. And the two possible outcomes of this trade is come expiration, if the stock stays above $9.50, our option will expire worthless. We'll keep the premium and we'll be returned our $950 of collateral. If, let's say, TSOL drops down to like $9, we're going to get assigned those shares at $9.50, and our collateral that we put up will be converted into the shares. So at this point, if we were assigned those shares, we'll take assignment. We're owning the shares. The next step would be the sell covered calls. So if we got assigned TSOL at $9.50, like I said, we want to be aiming the sell covered calls above our price. So in this example, we're looking at a $12.50 strike. And I do apologize. I realize that TSOL is not at these levels right now, as I can see Zach just drooling of seeing TSOL down here at these levels. But these
I
are
have
some
been
older
wheeling with them
screenshots.
today. Yeah.
Yeah, these are some older screenshots. So I do apologize if I got your hopes up, Zach. But TSOL is not at $10 today. I wish it was. Anyways, we'll continue on. So we are essentially agreeing to sell our 100 shares of TSOL that we got at $9.50, now at $12.50. So you can see we've got some built-in upside there of about $300 if I did my math right. We're going to collect another $50 in premium. And the outcomes of this trade is the stock's going to stay below $12.50. We're going to keep our shares, keep our $50 in premium, or if it goes and breaches $12.50, we're going to be forced to sell our shares at $12.50, regardless of how high it goes. We'll still keep the premium, we'll lose our shares, and ideally, we'll make a couple bucks with the upside move on our cost basis as well.
I'd love to chime in on this if you don't mind.
Sure.
TSOL is actually the first name that I wheeled. None of this is financial advice, of course, but the reason why I jumped over to TSOL and wheeling it was before that, was a bag holder of Tesla, TSLA, and had I was way oversized in terms of how much we should have had allocated towards Tesla. And this was back when I was listening to Charles Schwab's all day long broadcast, and they're making trade recommendations and that kind of thing. And the one morning I'm like, I couldn't have been more bullish on Tesla, went way too heavy on Tesla. And then what do you know? Of course, Tesla sees that I jumped in so heavy, just kidding, and decides to just dive for months. And now the thing is, I'm not bearish on Tesla at all. However, when you're sitting there bag holding stuff like that, and I didn't have 100 shares, I wasn't far from it, but I didn't have 100 shares at the time. And so I could not do anything with my money. I've heard people say that money, you want to treat it like they're soldiers going out into the field to do battle for you. Well, my soldiers are just sitting there hunkering down, taking a beating. They weren't doing anything for me. But eventually, what I did was, after so much time, and again, not financial advice, but couldn't be happier that I did. I switched over to TSLL. And actually in the form of cash secured puts initially, and got in pretty heavy with those and was making consistent money still on Tesla, but now with cash secured puts until eventually, like Hertzy's saying, it got assigned. That's okay. Sell covered calls until you wheel your way back out. So I could keep going and I won't, but that one just hit too close to home for me. I thought I'd add that quick story in.
Yeah, absolutely. I kind of same boat here, Zach. I started with TSOL as well. That was one of the first ones I kind of dabbled in. But yeah, it's a great one. It's still a foundation of my wheeling portfolio. One of my favorite tickers to wheel, obviously, just because of the elevated IV that you get, being that it's a leveraged fund, and it's really only one of the leveraged funds that has kind of held its own, I feel like. Um, but if you are new, I wouldn't recommend really any of the leverage funds until you kind of get a grip on it. But
Yeah.
TSO, I'd say, is probably one of the safer ones, but who knows? I mean, Tesla could get cut in half over something crazy. You never know. It is a very volatile name.
Couldn't
Um,
agree more with everything you just said. Yeah.
yep, absolutely. I just want to throw out, guys, if you guys have questions, please put them in the chat. This is for you guys, so please let us know, and then we'll also field some questions at the end. This is kind of a slept on slide and strategy here. This is one that I am really trying to get into eventually as I kind of grow my stack of capital. And it's one that we don't see a lot of people talking about just simply because dividend stocks seem to not pay well premium. Their premiums aren't great, but the triple income stream strategy is essentially that you're getting premium on cash secured puts, premium on covered calls. You're also collecting a dividend while you're also getting share appreciation. So this is kind of a more rare kind of golden strategy that we don't see a lot of people playing because a lot of people just aren't wheeling these dividend stocks. I would say most just one that comes to mind would be some of the big, dividend guys, whether it's like Home Depot, Caterpillar, and a lot of those stocks are pretty pricey. So there's a bear to entry to get into them. But yeah, obviously the IV is not as good as well, so you're not collecting a lot of premium up front. But I would just like to throw that in there that is a solid strategy eventually, and a little bit more conservative as well. So let's talk a little bit about stock selection and portfolio design. This is a good segue after talking about the triple income idea. So finding your five. This is a big thing that I want to emphasize, especially for any beginners in here. I know Zach has really kind of started to embrace this. Maybe if it's not five, it might be 10 to 12 for him. And this was kind of my five at one point. Like I said, these are a little bit outdated slides. Um, but I would like to just emphasize stick to 5 to 10 companies, not 20, not 30, and just become an expert on how they move, different levels, whether they're in a range, how they react to earnings calls, things like that. Zach, you got any input on this? I know you kind of just recently, I know you've been narrowing down your list and talking about how you're just sticking to a list, and I think that's all really great stuff.
Yeah. I think 2025 did really well with options, but I was a little bit more of chasing shiny objects sometimes. And some of those shiny objects, there's a real reason I was doing that. And I'm wording that in a way that makes me sound like total idiot. They weren't totally idiot moves, but they're probably a little riskier than I should have been going. And took some damage on certain names. Overall, did great, but getting into 2026, wanting to refine things a little bit. A friend of mine encouraged me to try to focus on 10 tickers, and I thought, oh my gosh, 10! My watch list for wheelable names is like 100 or so. I mean, like, how can I narrow it down to 10? So at first, it did feel like kind of squeezing into a straitjacket. Not my favorite feeling, but getting into it, after a month or two, I thought, what, this is actually pretty great because, like you're saying there, Hertzy, then you're actually staying on top of when are earnings reports coming out, or what's the big news. Like PayPal is on my list, and so I am immediately keenly aware of what's going on with them every single day. Whereas I would never even think to keep an eye on those guys, otherwise, things like that. So couldn't agree more. Now, I would say this in all fairness, I feel like it's been really helpful to me. Hertzy would say the same, or has already said the same thing. Lion in our group does the same thing, or tries to. Michael is another great trader in our group, and he does not do this. And that doesn't mean he's wrong and we're right, or vice versa. It's just another, angle here. His take is no, I want to have a lot of diversification. So if something does fall, something nasty happens, all of a sudden so and so ends up in the Epstein files or whatever awful thing, then everything else is okay. And so I think that to a degree is valid as well. But he's also very, very experienced, has a lot of success behind him. So I don't know if I'll end up getting back to that or not, but for now I'm with you, Ritzy, on trying to keep the focus on maybe 10-ish for me. But five even better. I know Lion, he wants to drill down to just maybe a handful as well. So yeah, that's good stuff.
Yeah, absolutely. And just to add to that quick, just so we don't spend all day on this slide, but I do think that's a really good point when you're talking about Michael and keeping it diversified. Um, I don't know if this is a great example. This isn't really my up-to-date list of finding my five, but just be sure that maybe you don't see a lot of sector overlap in your five. That could also help with diversification, or maybe it's ten different tickers. Just kind of make sure you're not. So, like for example, just for this one, I've got Hood here up at the top. I wouldn't also expect to see SoFi in here. If you got two big fintechs, I would maybe just pick one or the other just to keep that diversification. Just something to note. Same example could be like Rocket Lab if you had ASTS in here as well. You've got two big space companies, and these listed here also very high beta. So maybe you'd want to throw in some more lower beta stuff as well. But anyways, we'll continue on. That's a great point about diversification. A little bit of technical analysis here. Very basic. I like to keep it as basic as can be. We've got some people in here that are doing models and crazy stuff, and it's all awesome. Um, but just a good example. This chart is not up to date. I actually don't know what Riot's at. This Riot's been completely removed from my portfolio in the last 12 months as well. So kind of an older thing. But it's pretty simple. Whatever charting platform you like to use, I like to use stockcharts.com. It's very simple to me. I don't know why. My eyeballs like it. You can see here, I've just drawn, I guess, a couple supply demand zones, just where some prices are consolidating. And simply I'm going to go in here and say, okay, so right now in this example, Riot's at about 10 bucks, 10 and a half bucks. I think it's a buy at 9.5, and I think it's a steal at 7.5. So just knowing like your buy and steal zones is a great thing to do. Just some basic TA. Obviously, there's a lot of other lines and things on here, but just wanted to focus on kind of a longer time frame chart, highlighting some zones that you would want to label as buy and steal zones for different entries. And these entries could be strike prices for a cash secured put, for example. And you can do it opposite as well when you're selling covered calls. You could have like a sell and like I'm 100% going to sell zone as well. Zach, you want to chime in on this?
Yeah, the only thing I was going to say was this is, not only a wonderful idea, very, very good recommendation, but also I think ties into that last slide of, hey, if you have 5 or 10 tickers that you're keeping an eye on, you can do this. Now if you have 100 tickers you're trying to keep an eye on, good luck. And who has every single entry and exit point and everything? Who can monitor 100 tickers a day? Realistically, for years, right? And a quick example of this was just a day or two ago. Hims, keeps coming up. No offense, Hims, but it was so beaten down this week that I mentioned in the two groups that I'm in, hey, boy, Hims it's almost attractive to me at this point. I know I shouldn't say that. It's not in my top 10, but and fortunately, two friends talked sense into me. And one of them said, "Hey, it looks great because you were wheeling it at a higher price and it's fallen and fallen, fallen, it's fallen 50% or so this year to date or something like that, something awful. And so that's why it's attractive to me. He goes, but if you zoom out a couple more years and now look at the chart, you'll see that we're still not back at, there's so much more room to fall. It wasn't that long ago at all when it was still actually a lot lower than it is now currently, even though it's already what appears to be a huge discount. So I'm not saying wheel it, I'm not saying don't wheel it, I'm just saying that if it were in my top 10, I would have known that. I would have said, actually, you know what, this isn't a good level. Maybe if it gets down to 5, where if it completes a round trip back to its previous, initial base or whatever, then anyways, I'll stop yapping. But hopefully that's helpful and speaks to these 2 slides here.
Yeah, absolutely. And I don't know if we'll have time at the end, but I did throw some time in for some live examples, and I think I did have HIMS pulled up is what we were going to look at. So we'll take a look. Some different capital deployment methods here, guys. This isn't to live by and to die by, but just some different things that I would like to throw out there. First one being method 1. I like to call it the bullet method. Kind of going back to those buy and steal zones. Set up your zones. Let's say you set aside X amount of dollars for this specific ticker and it hits your buy zone. Throw a 25% bullet at it of what you want your max position to be. Let's say it keeps dropping closer to your steal zone. Okay, now you can deploy another 25% bullet of your max position, what you want it to be. And you never know. So let's say it drops even more, then you can throw a 50% kind of buffer bullet in there. And that's not exactly how that scenario might pan out, but just keep that in mind, to not just ape in your whole max position you want to be at a certain level. Another method you can do is kind of just keeping an eye on what you're allocating that position size to. So maybe you're using 25% cash secured puts, the other 25% is looking for that more upside cap with covered calls. With your shares, you're holding the underlying, and maybe you're keeping 50% for reserve. As you kind of build out that position, those numbers could change. But just some kind of different philosophies you can use. I wouldn't ever recommend someone just blindly start throwing money at a position without having a goal of what you want that position to one day look like. So just some ideas that you can do for kind of starting your entries. And you can also scale this out with your exits as well. Just some portfolio examples based on account size. This kind of ties into the other slide, and this is going to be a very personal thing to sit down and go over. And it really depends on your strategy. Between Zach and I, our strategies are very different, even though we're doing the same things, usually trading the same tickers day to day. But everyone's strategy is a little bit different. So these numbers are not verbatims. Keep that in mind. But just an example, let's say you have $100,000 portfolio. Maybe you're trying to tie up 40 to 50% of that collateral of your 100 grand into just cash secured puts. You're trying to acquire stocks that you want to own at a discount and just you're wheeling, collecting premium. Another 30 to 40% is going to be tied into shares that you're now deploying covered calls on, you're earning premium in that form. Maybe you're saving another 5 to 10% of that for advanced strategies, whether that's going to be credit spreads or leaps, things like that. And then I would also always recommend to have some sort of dry powder fund, just cash in case we do get some sort of black swan or dip, or your favorite company gets crushed from some headline. So you have some extra money sitting around so you don't feel bad and you can deploy it on a dip. Zach, you got anything to add on those last couple of slides? I don't want to leave you hanging dry here. Feel free to chime
No
in
problem at all.
whenever.
I mean, you're saying a lot of good stuff, and this is going to look different for everybody. The one thing that I'll add that isn't mentioned here that could be worth mentioning is, unless you really, really, really need margin enabled, I think it can be really nice to not have margin enabled if you are doing strict wheeling. It's, I think, after having spent significant time in both margin enabled and no margin accounts, boy, there's so much peace of mind in not having to use margin. So in addition to, having some cash left over for, buying the dip or getting more cash secured puts on dips, like I feel like, we've been in some dips, so I've been deploying everything I can right now. But man, also staying out of margin though. I don't want to go using margin just because, wow, things are nice and beaten down, I better use margin. I mean, you're taking out a loan, and boy, there's a chance that things don't rip like you thought they would, and that's not going to be a fun thing to have to deal with. So, if you're doing things like strangles, or you would technically need that, but otherwise, I personally don't recommend having margin enabled on any accounts, just to kind of keep yourself safe. So,
And I would agree. I would agree. Unless you have a very good idea of what you're getting yourself into, and or you have a very good set of rules and strategies that you've been able to kind of navigate the last couple years in market cycles without getting burnt. At that point, maybe you could consider margin if you've got something really set in stone there. But just be very careful with it. I would like to throw in, I don't want to throw any beginners off here, but there's a lot of talks lately on X or within the community of this new concept of a portfolio secured put, saying that that's not leverage. That is 100% leverage. You're still getting double the downside risk. So please keep that in mind. There's been some chatter about that, which I 100% would like to throw out my opinion on that is still a leveraged type of exchange. So keep that in mind. Let's talk a little bit about position sizing rules. Like I said, guys, this is all going to be personalized towards you. Just some very basic concepts here and ideas you could kind of go off of. So we'll start with single trade risk. Typically, I might be more towards like the 1 to 5%, but 1 to 3% of your portfolio max loss on a defined risk trade. So that would be like a cash secured put or something like that. Um, Cash secured put allocation, no more than 2 to 4 positions if fully cash secured. That's going to vary. It's really going to depend on your total capital that you're working with, and more of a percentage wise. This one, next one, talking about covered calls. This is more my strategy. Zach might not be fully on board with this because he likes to kind of just wheel in and out. But like, let's give my precious Rocket Lab stock a little shout out for an example here. So I only sell calls on about 20 to 50% of that my position to keep the upside. And I would say I'm more towards like the 0 to 20% here, not 20 to 50% on Rocket Lab specifically. So some of that higher conviction stuff, as I'm still selling options on it, I don't want to cap all my upside if I think Rocket Lab's going to be a $200 company in 10 years or maybe 5 years. Who knows exactly? Or it could go to 0. We never know. I'm not a god here when it comes to picking stocks, but just keep that in mind. If you do have some of that higher conviction stuff that you would like to still bring some premium in on with some covered calls, don't sell covered calls on all of your shares. So keep some of them unexposed. If you're wheeling it 100%, just keep it all covered if you want just the premiums. But keep that in mind. And Zach, I guess you can chime in on that if you want, because it looks like we're transitioning into the next segment here.
Yeah. And I know Tesla Groupie, she does the same thing. She only wants to cover maximum 50% of her shares with covered calls. And I think it's just gonna be different for everybody. I try to keep everything pretty covered, but that's I try not to ever go below my strike unless there's really specific reasons, and it's done with extreme care, and it's usually a very temporary thing. Um, but yeah, but then we'll have days like today where I feel like, okay, we have NVIDIA earnings. I'm going to take off all my covered calls or most of them. So that's what I spent a good portion of my morning doing today. Any covered calls that were not in the red, in terms of current profit and loss, locked in gains, closed them out for now. Let those shares breathe. There's a chance that they will be ripping. I don't know. They may not, but there's a good chance that they could, decide to start ripping for the rest of the week here. We'll see. So certain things like that, absolutely. But okay, back to
That's a
you.
great point. I really hope I have a slide in here on binary events because that would be a great example for today, also known as NVIDIA earnings. Pretty much what's going to happen with the overall market. But anyways, we'll continue on into executing profitable trades. I believe this is when we get into more of an example. Let me click through here. Yeah, this is hymns, and this is just painful. I'm sorry for putting this one in here, guys. We've got this screenshot hymns $52. So I do apologize. We might just skip over this to keep some of the collateral damage out of it. But
It is in
here,
the shape of a dinosaur, which is what we feel like sharing this slide.
yep, yep. Um, let's see here. Okay, there's some good info on this slide. So even though we've got some damage here still was showing such pain on the screen, but there is some good stuff here. Um, just to note out, maybe not hymns is a great example, but a strike price that you don't mind owning the underline is a good emphasis line right there. Um, and then this is kind of more, it's going to be very, up to you, but pick an expiration. I'm starting to really like 45 days to expiration, manage them about halfway through with 21 days to expiration. Or you can go weeklies, less time, more stuff to manage. It's really up to you. There's no really one size fit all strategy when it comes to selling options.
I think that partly has to do with how much time you have to manage as well, kind of like what you were saying there. Some folks, they have full-time jobs and whatnot. They can't be messing around with this all day, every day. So weeklies might not be the right fit for them. Last year, weeklies were my jam. This year, for different reasons, I've gotten a little bit more into like monthlies and leaps, but still have a heart for weeklies and wouldn't mind getting back to them depending on how the market kind of starts to go here pretty soon. So
Yep, absolutely. And I kind of do a mixture of both. So I'd say half of my stuff is weeklies, half is more 45 days to expiration, and then I've been starting to implement so like some longer stuff like backstop trades. So those are all over a year out. You see Lion doing a lot of that stuff as well. So kind of just a good mixture. I like to stagger my expiration days, things like that. So let's talk a little bit more about all the stuff that no one wants to talk about, but it's all really good things to go over. So first off, being capital preservation. The one thing I'd like to point out is the biggest thing when it comes to selling options is not losing money. So take profits early. Keep in mind that one big loss can wipe out essentially your whole positive uh, gains of premiums. So roll when it makes sense. Don't force a roll, things like that. We talked about position sizing already. Cash and diversification, we've talked about a little bit, maintaining some cash buffers, spreading trades across tickers, sectors, and strategies. We haven't talked a lot about exit and adjustment rules. This is going to vary based on your strategy and what fits. A lot of guys are going to be setting profit targets, whether it's like 50 to 70%. I'm not sure if ever a lot of people are cutting losers early and setting stop losses, but it's something you could consider. I don't do a lot of that when it comes to selling options because I know that theta is working for me, even when I'm not watching it. And then roll if needed. If the narrative hasn't changed, feel free to roll. You see Zach doing that a lot with his rock and roll campaign, I would like to call it, which I think it's just awesome. Some of these little silly things, whether it's the Subway sandwiches or the rock and roll, lock and roll stuff. This is all great. Um,
Got to have fun with it. You know, if you're going to be doing it for years, try to enjoy it, right?
yeah, we should trademark all this stuff, make some T-shirts. Anyways, maybe one day. We're still just nobodies that don't know what they're talking about, but here we are. Glad to have a couple of you guys listening in. But market awareness, I knew I had something in here. So like Nvidia earnings today, Zach pointed out taking off his covered calls. That's great stuff. Um, size down into high volatility events. So that's pretty much just explains exactly what Zach did. We're taking off some of his covered calls, taking profits on that. Tracking the VIX and trends. So whether that's earning calls, binary events, Fed announcements, things like that. Advanced protection, I don't really want to get a ton into that. Essentially, that's going to be some more advanced stuff, which I don't think we need to really get into today. And then just your long-term edge is small, consistent wins compound, protecting your capital to stay ahead of the game. All right. Rolling puts and calls to avoid losses. So rolling up and out, know when to roll them, know when to fold them, wheel versus long-term play, things like that. I think I had an example video here. I'm not going to play it, but just keep in mind if you're wheeling stocks and that's your main strategy is you're like an aggressive wheeler, you probably shouldn't be rolling a lot. I know Zach rolls them essentially because he's taking profits and then just opening another position. So instead of making like two transactions, it's just an easy conversion into one transaction. But I'm talking more about like, let's say your TSL covered call strike price got breached and you're just wheeling TSL. You really probably shouldn't be rolling a ton. Maybe roll once and then if you're still going to be underwater, just let your shares go and then start your wheel strategy back over again, selling cash secured puts. If it's more of a long term play like my Rocket Lab, for example, and I don't want to lose my shares, that's when I'm going to kind of be rolling and just slapping the band aid on it to hopefully get out of that trade without being super underwater. All right, we'll continue on. Avoiding over leverage. We've already talked about that. Be careful with margin. Margin calls are real, which we have seen in the last kind of beginning of the year. A lot of people getting hit with margin calls. And I think me and Zach are kind of both on the same page that margin should probably be avoided unless you really, really know what you're doing. Some advanced strategies, some poor man's covered calls. I really like these. I've implemented them a lot last year. I haven't done a ton this year. I'd really like to try to get back into them a little bit more. And if you guys have questions, feel free to throw them in the chat, like I've said. But a poor man's covered call is essentially that you're going to be buying a leap, so a long call. I won't get super in depth here. We could probably have a whole presentation just talking about poor man's covered calls and leaps. But essentially, you're buying this long call. I like to go in the money about like a 0.70, 0.80 delta, and then you're going to be able to sell covered calls because your position is covered from your long call to essentially be able to control 100 shares of the underlying by paying that premium to have that long call contract. That's your collateral, so it'd still be a covered position. But there's some considerations with that. With your leap contract, your long call, you're going to be now on the bad side of the theta decay. Early assignment risks on your short call as well, and then just kind of how theta ramps up towards expiration. We've got a question here, or a comment. Throw that up there. Happy we covered how dangerous portfolio secured puts are and how Greeks work. I knew that Theta Beast never takes a break, even on weekends and holidays, but I never knew that it slows down. Yeah, I'm glad you're enjoying it. Yeah, with your comment of that theta is never takes a break, that is true. And then just keep in mind, like how me and Zach had pointed out, that it's essentially built in for holidays and weekends. So no, you can't open up positions on Friday and then close them Monday morning, or that would just be a cheat code in the system. But yes, theta is essentially always working, but it will be priced in for the holidays and weekends. Oh, let's see. It's more of a spreadsheet example. We'll probably skip over that. But essentially, this is one thing that I like to do along with wheeling is trying to lower my adjusted cost basis to zero. So my adjusted cost basis would be the cost of my shares in addition to any premiums I've collected, whether that's via cash secured puts, uh, or covered calls. Essentially, I'm taking that premium and I'm adjusting my cost basis. Um, so on paper, I'm owning some of my higher conviction shares for free. And that's kind of my goals with a lot of my higher conviction stuff along with wheeling. And there's some different spreadsheets and things that I have. If you guys are interested, I have some ways that you can calculate that if you wanted to. Moving on, I think we're getting towards the end here, guys. Scaling your options business. So like Zach said, he's a business owner. I'm an ex-business owner. You should be treating selling options like a business. I won't kind of read this verbatim, but just some things because I know we've covered a lot of this is building a strong foundation, tracking performance, following a strict set of rules, standardize your repeatable strategies. I would emphasis on your strategies being basic when you're starting out, probably just cash secured puts, covered calls, maybe some spreads if you want to throw them in there. Increase your capital efficiency, use diversity to reduce risk, leverage automation and tools. That's kind of a new thing that we're seeing blow up across all industries. Just keep in mind that a lot of this stuff that's coming out is can be brought over into the option selling realm, whether that's using AI, things like that. And then compound and scale smartly. I like to always share this. I've shared this on X a bunch. The power of selling options. A lot of people look at me like I'm crazy, but this is true. True numbers if you can stick to it, targeting 2 to 2.5% per month of some different things you would be seeing based on how much capital you're working with. Zach, you got anything to chime in as we go into the next little bit here? I think we're nearing the end.
Not so much. That last slide, I think, some people might say, oh, that's ridiculous. And, some people might say that's too low. Some people would say it's too high. And, you're always going to have critics, right? I think one thing to keep in mind is, we're talking about premiums coming in. You never know what the stock market's going to do. Kind of getting back to that old Tesla example from, gosh, about an hour ago, where your bag holding, that may not do anything for you. You might not see any gains, but I like that phrase. I'm bullish on time. Like we know that time is going to continue to pass, and that's why Hertzie and I really like theta. Just getting paid to sit there and have options open that preferably are going to be just fine for you either way, whether they go one way or the other. It's you want to get into those win-win situations. But I think just to speak to that last slide just a little bit more, no matter where you stand on whether you think that was too high, too low, too whatever, we're talking about the premiums coming in. We're not talking about and it may be your overall unrealized portfolio gains or losses as well. But a lot of times we're just focusing on those premiums. Like, hey, as long as we can keep getting however many hundreds or thousands of dollars, whatever your goal is per week, with options income, maybe that's your goal, or per month, and that's absolutely, in my opinion, that's absolutely doable. What he just shared there. We're not talking about overall. although that can happen as well. But in terms of the premiums that are coming back in, and yes, those do compound because then you can sell options on those, whatever you use that money for as well, of course. So, all right, back to you.
Yeah, absolutely. That's why I didn't spend a ton of time on that slide because I get a lot of mixed kind of feedback of, oh, that's way too high, or whoa, that's way too low. And you can really never make anyone happy. So that's why I kind of stay right in the middle. I like to vouch 1 to 3% of premiums per month is kind of a good way to start with setting your goals. I've had people say, well, okay, I'm getting 8%. I'm like, okay, well, do that for the next 2 years and, report back and let me know if you did 8% in premiums per month. It's just not going to happen. Um, but if you average it out, maybe you have 1 month where you do 10% just premiums, 1 month you do -2%, 1 month you do 0%, 1 month you do 4. It just kind of averages out. That's why I like to throw that 1 to 3% in there. Quick question here. Let's hop into this because this is a very easy one. What delta ranges do you guys recommend for wheeling? I'm not going to give you a range. I'm just going to give you 0.25. It seems like a sweet spot for me. I like it. I don't know why. Zach, you can chime in.
Yeah, I would say 2025 Zach was really loving 0.25 to even up to like zero point 0.5. If I knew the situation well enough, if I know a ticker like the back of my hand, or at least I think I do, might even be that bold. 2026 Zach is looking more at like 0.15 to 0.25 or ish, just kind of depending on what it is. And I think too, it's not at least for me, not a one size fits all answer. For example, I'm trying to work my way out of strangles a little bit at the moment, but if I was selling naked calls on a strangle, boy, you want to go less than 0.15. I mean, we're talking more like 0.08 or 0.07, because you really don't want to be challenged on those naked calls. Not, none of financial advice. But now, if I'm thinking about something like a Leap cash secured put that's maybe January 2027 expiration, boy, I love the 0.15 ish or maybe 0.25, somewhere real low like that. Now, if I'm just doing weeklies and I know TSLL, it's like it's been beaten down long enough. It looks like it's ready to launch back up to the 20s or something. Okay, I might get a little bit sportier point. I might, 0.3 or 0.4 even, somewhere in that neighborhood. But just really depends on, are we talking weeklies, monthlies, yearlies? Are we talking calls? Are we talking puts? And if it's covered calls, and if I'm just happy to get rid of the shares that I own, like I have to be sitting on a whole bunch of like Webull and BBAI and Mara and like other things where like I'm ready to part ways with it, but I don't want to take a realized loss. Like I'm absolutely selling at most at my entry point. I don't at my assignment price. I mean, I don't really care what the delta. I'm not even looking at the delta in that case. Like I got in at $6. I'm getting out at $6. I won't take less than that, and I don't really want to wait around for more than that. So I don't really care what that delta looks like. So, all right, I'll stop you, Evan.
No, that's a great answer. A little better than mine, but the best way to just kind of format that is it depends. It depends on your strategy, your goal, the ticker, maybe some different things like that. So really good stuff there, Zach. Um, we'll continue on to taxes and record keeping. I'm not going to dive into the boredom of record keeping and spreadsheets. We could probably do a whole live just on that. And I'm not a CPA, so I'm not going to give you any tax advice. But just keep in mind that taxes you'll have to pay eventually. So that's all I'm going to really say with that. Some short-term versus long-term taxation. Um, I'm not going to read that. Once again, I'm not a tax expert, so just some things if you didn't know, there is a difference between short-term capital gains tax and long-term capital gains tax. And there is some different ways that the options, when you're selling an option, how it is taxed, which I believe is what I actually have put up here. So when you're selling an option, I believe this is an older slide. I don't know if the tax laws have changed, but 60% of the gain is going to be taxed at long-term capital gains rates, and 40% of that gain will be taxed at a short-term capital gains rate. That's my understanding the last time I've looked at, but taxes and me don't get along, so I'm not an expert. So just keep that in mind. But I think that's the verbatim Google answer if you Google how an option, selling an option, how it's taxed wise. We could talk a little bit about wash sales. Once again, not a tax expert. Just keep this in mind if you're trying to implement any wash sale strategies, that you can't buy or the substantially identical security within 30 days before or after the sale, when it comes to wash sales. And that's going to be for stocks, ETFs, or options at a loss. So just keep that in mind that you can't really touch that ticker when it comes to that wash sale stuff. And that's all old stuff. That's old. Let's keep it going here. So wheel trading checklist. So this is something that, even though this is an older slide, it's definitely one that I kind of still use. And this is going to be something that you can come up with on your own. And this is going to look very different between mine and Zach's. But just for an example here, we'll breeze through this really quickly. Before I enter any sort of trade, and this has changed a little bit because I've got fancier tools I'm dealing with now, like the fancy GEX, heat maps, things like that. But first thing I want to do is check binary events. So let's say you're going to go sell a covered call today. You should probably know that NVIDIA reports earnings after hours. So keep that in mind. So do your research, analyze the chart, check IV, check volume open interest, position size check, and then always do your emotional check as well. You don't want to be entering these trades in any sort of emotional way. Some different websites and resources. Once again, this is kind of outdated, but FinViz, stock charts, bar charts, stock analysis, quant data. There's a lot of other things that this whole page could be filled with different resources. But these are just a few of them that I have used in the past. Perfect. Well, this is the end of my quasi put together slideshow for you guys. I appreciate you guys bearing with some of the older content in here. This was something that I put together kind of towards the beginning of 2025, and I would like to update it, go through, and get any feedback. But yeah, I do apologize for some of the pain and suffering, like the hymns screenshots in there. Um, I probably should have went back and looked at that before I presented that today. So I hope I did not hurt anyone's feelings, and I hope everyone has stayed with us here. But yeah, Zach, closing thoughts. If not, we'll just open it up to questions, and if we want to look at any examples, chat about anything else.
I think you covered a lot of really good stuff there. I don't think I have anything else to add other than hopefully NVIDIA earnings goes well today. I think a couple outdated slides, no big deal at all. Still a lot of, really good content regardless, so no biggie whatsoever. NVIDIA, hopefully that'll go well. If so, rising tide could potentially lift all ships. We'll see. And
that's my favorite thing right there.
Yeah, I wouldn't mind. If not, then we throw the covered calls back on tomorrow, and keep on rolling, right? So yeah, no. If anybody else has any questions, now's a great time. Or if not, or if you think of them later, we're of course around on Discord and on X and everything. So
yeah, absolutely. If you guys have any questions, please let us know. Appreciate you guys tuning in. This will be recorded for everyone that was not cool enough to come hang out with us for an hour today. I know people have jobs. I know these are really, really poorly planned events as well. So part of it's on us. But we also, and Zach and the others, Lion, Michael, we also have commitments as well in life besides Discord, believe it or not. But if you guys have questions, let us know. If not, I was just going to pull up a quick heat map on NVIDIA to kind of sign off today, and we can kind of see what's going on. There it
So we
is.
got a comment. Great job, guys. I'm going to share this video with some of my friends and family members who are wanting to get into option trading. Awesome, awesome, very cool, and happy to help. Glad you enjoyed it. And yeah, we have a great community. If you're not already in there on Discord, doesn't cost anything to join, by the way. And I feel like it's a great environment for folks who are just getting into, not that it's exclusively for people who are new to options trading, but really, really good for folks who are new and or looking to get into options trading. So
Absolutely. Welcoming of all, for sure. Appreciate you sharing it with friends and family. Do apologize in advance that they have to listen to us talk, but hopefully they do get some good information out of it. But yeah, awesome. Really appreciate you being here. This is the NVIDIA heat map, GEX heat map for today, I believe. Yeah. I don't know, Zach. I don't see it's this one looks weird for NVIDIA, or is that just me? I feel like we should have more colored in nodes.
Yeah, it's really hard for me to see the specifics, but it's funny. Like if we look, it looks like the biggest node is to the right. That purple node right there. It's hard for me to read that. I'm not sure what we're looking at. What's the strike price on that one?
That is a $200 strike for March 20th.
Ooh, okay. So, and then what are we looking at for this week? What's the largest number that you're seeing for this week?
Also $200 strike for the 27th. So Friday.
Really? Huh.
Yep.
Boy, that is crazy. Yeah, that's interesting. That is interesting. So, and those don't have a minus sign in front of them. Is that correct? Those are positive
Correct.
numbers.
Actually, the minus sign doesn't start until 187.5.
Okay. And that's how many million is that?
3.43 million at 187.5 negative there.
Interesting. So I wonder how this will end up going, and I was just telling or reminding a friend this morning that this isn't the Bible, this isn't like, okay, this isn't God. Don't go betting your life savings on what you're seeing here if you do know how to read these. The two things that I would say about heat maps, the majority of the time they can be very helpful. I would say kind of like checking the weather forecast. Like, okay, this is probably going to be, if checking the weather forecast for like a week or a month out. Okay, so it's like that's probably going to give me better direction than if I didn't look at it at all. But I also am not going to hold them to it like, hey, there wasn't exactly 68 degrees, on next Friday. It's like, no, it might be a little bit off, or it may have changed since then. So I would say approximately 70%, pretty correct. The other thing I would say about these heat maps is I love them and I use them, but they can change, right? And so while this is what we're seeing right now, who's to say this is a very active ticker? Who's to say at 3 p.m. that it could look pretty different? At 3:50 p.m. it could look very different. So it's one of those things where even if you were going to use this heat map for a trade, which I'm not saying do or don't, I'm just saying if, the wise thing to do then would be to really, really keep an eye on it and know that it's not a 100% for sure thing. So in like PayPal was a good example of that. A friend of mine and I were looking at the PayPal. heat maps this morning and saying, wow, these are so different from just a week or two ago. And, you know, some really big news happened. They may be being acquired, maybe even by Stripe. We don't know. But wow, now the large nodes, the brightest nodes on the heat map are very different than they were just a couple of weeks ago. So it's not a set it and forget it thing. You really do have to keep an eye on it. So I tell folks, if you're going to use these, probably good to just use it for one or two tickers or whatever you can mentally handle staying on top of. I liken it to trying to stay on top of a squirrel running around in your backyard. You probably don't want to have to watch him for too long, or especially like 5 or 10 squirrels. Good luck monitoring all of them for, that's just not going to be fun. And that is kind of what it feels like, especially on certain tickers that are more active than others. So
Absolutely.
Couple thoughts.
Yeah. And just Zach, correct me if I'm wrong, but just for the people that don't know, so if it is a negative number, that would mean that there's more puts versus calls.
Well, I'll simply say that we're measuring gamma, and to try to say it simply, if it's a negative number, commonly what we'll see how the price action will play out is if the price action touches one of these nodes and it's a negative number, it's almost like if you've ever played Mario Kart and you're racing and you get on one of those little turbo arrow things that just propels you forward. It commonly will go like that, where it's going to not just touch that node, but actually pass through it very aggressively. And there are different reasons for that. And that take 5 or 10 minutes to get into, so we won't. But we can talk about it later if anybody wants to. But the positive number nodes that you see on the heat map are commonly more acting like brick walls. A lot of people will use the terms call walls or put walls. So a lot of times we'll see a number well above where we're at that is a positive number. It doesn't have a minus sign in front of it, in other words. It's the biggest, brightest node on the heat map. And a lot of times that is representing institutional sellers and or algorithms that have a lot going on at that particular strike price and expiration date. And a lot of times those positions will be protected like crazy. And so if you see a positive number like that and the price is going up to it, and a lot of times it does gravitate up to it, certain things, institutions and whatnot can do what they can to drive that price back down to protect their sold call positions. So you want to be really careful at how you use those. But I have successfully wheeled, thousands of contracts using the heat maps where it's just, I think I could say thousands, if not many hundreds, but I think thousands successfully, where it's like, okay, I'm going to see where the call walls are at, and I'm going to sell my covered calls a little bit above those, not at those and not below those, but above those, even though my assignment price is way up here. So you could use, that's a good way to possibly use those. So getting back, positive numbers, negative numbers mean two different things. They can both act like magnets and pull the price action toward them. So you want to keep an eye on the biggest nodes, the biggest numbers. The price action is commonly going to gravitate towards them. If it's a negative number, pass through them very quickly. If it's a positive number, can act like a wall that's going to stop and maybe even reject them. So hopefully that's helpful to somebody out there.
That's awesome. That's a very good explanation there. Cool. And as you were going through that, I did pull up some order flow for NVIDIA just because I was curious on it. And this first one, I know this is probably very brutal to see, guys, so I do apologize. But so I will read it off. So I have this filtered for bearish or neutral order flow on the call side for NVIDIA. So that would be like a naked call or a covered call, things like that, because it's a bearish sentiment and it is out of the money. And this one really caught my eye, this first top one. This person or persons or institution, we don't really know, but they sold a call March 20th is the expiration date. They did 1,000 contracts at a $200 strike price, and they brought in $867,000 in premium. So that's almost $1 million trade there. I could do the math on how much collateral they put up for that, but that's a lot of money. So
Yeah. So that's, are you just using, are you just looking at bearish, or are you looking at bullish and bearish, and this is just what you're seeing?
This was just the bearish flow for now. I can pull up the bullish flow, which would indicate more of a cash secured put strategy. I can pull that up, but I just wanted to point out and show right now that there is a ton of big number premium blocks here for between kind of today and out and towards the end of March, where these people are really looking at like the 200, between 200 and 215 for the strike price. A lot of bearish sentiment, big order blocks. A lot of these 867,000, that's a $500,000, 742,000, a lot more that are almost a $500,000. Which a lot of these were within the last 2 hours they were placed, which is just interesting to see. I will go over just because I don't want to be biased towards one side, and we can take a look at the bullish flow, just see how it compares. So we'll deactivate that and we'll look at NVIDIA for bullish flow. And we can kind of see, okay, so this is even more intriguing to me. This is definitely the biggest order flow compared to the other one. March 6th, so that would be next Friday. 192 cash secured puts, or it could be a naked put for March 6th. So next Friday, $192.50 strike on NVIDIA, picked up
Go.
1.3 million.
Nice. I like to see that more than that last slide.
Yeah. Yeah, for sure.
Good to see both, though. Honestly, yeah.
Yeah, and another pretty big heavy hitter. This is just shy of $1 million in premium. Same expiration, March 6th, $180 strike price. Some very big orders as well down there. But yeah, that's,
so those are cash secured puts that are being sold, or just naked puts that are being sold puts regardless.
some sort of, yeah, essentially it would have to be some sort of sold put.
Yeah. Okay.
There's really no way to tell what exact strategy on the capital side they're using, but
yeah, of course that makes sense, but just sold puts in general. Yeah, great. Okay, well, that's great. It'll be interesting to see. You know, the GEX heat maps at the moment almost look like, is this going to be a nothing burger? You know, because it's like the big heavy node wasn't all that north of where we're at already. However, you know, keep in mind, again, this could change, and it's also, even if it doesn't change between now and end of day, which I'd be shocked, it's not 100% accurate, but it's usually more, it's more accurate than it isn't. So, or else we we would not be wasting our time looking at these things. So, yeah.
Yeah, I mean, just going off of your very good explanation earlier, Zach, I think if we see downside with NVIDIA, gosh, I mean, it's hard to tell, but it would have to get pretty low, like 187. I mean, I don't know. I'm not sure if I want to even throw out a theory there, because who knows what will happen. But
interesting stuff. Well, this will be a fun one. You know, what I'd love to do, and maybe sometime for the future, whether we did this public facing or not, I would love to just go back through saved heat maps that we've looked at and say how did they play out, and review 25 of them or review 100 of them. And I do that every once in a while, but I haven't done it in the last couple months. And boy, I feel like that can be so helpful. And it's one of those things, I say it every once in a while, so apologies for sounding like a broken record. If GEX heat maps do not bear good fruit, I don't want to use them anymore. I'm not so stuck on them that I'm going to root for them no matter what. That's not me. If I want the truth, and if they are not helpful, I don't want to use them. I use them because they've been helpful enough in the past. But, I think it's one of those things where it could be like, wow, well, if it was right 90% of the time or whatever it is, boy, let's use these a little bit more, actually. Maybe we need to dust these off and use them a little bit more, but whatever the case may be, right? Could be a fun theme for one in the future or something, but who knows?
Yeah, I love that idea. We'll have to talk more, Zach, see if we
Yeah,
can
yeah, I'll talk more
implement
later.
that a
Yeah.
little bit. Well, I don't want to keep you guys all day. If you guys have questions, throw them in the chat. One last thing I wanted to look at, and then we're going to sign off and call it wraps. NVIDIA's implied move, what I'm seeing is around 5.5%. So I can just show you quickly some things that I use if I want to kind of get an idea of what's going on with that. So we're at it right around 197 here. So I'll put a line there, and then essentially I'll just go in here, and apologize if this is pretty small, but I just want to get a good look at kind of where we could see this thing go. And then you can always take this information and go back to the heat maps and kind of see how much the implied move is cooked into those heat maps as well. And this isn't going to be exact, but I'll get it as close as I can. And then I'll draw some lines here on those and kind of see what we're dealing with. But
Love it.
essentially, if I kind of cake in, let's save changes. Okay. Can I zoom in on this? That might be a little bit better. So I've got our median price 197-ish. That's where we're sitting at now. And then I kind of drew that 5.5% upside downside, which puts us around 186 for the bottom side of it, and all the way up to around 208 for the top side of it. So 186 to 208 can go back to the heat maps and kind of see. So that 186, if we hit that, we've got a negative number, 3.3 million. So we could slip and slide all the way down to 185, and then 208. We've got a lot of positive green blocks above that. So who knows?
Yeah, I'm trying to pull it up quickly on my end just because it's hard for me to read the numbers on the screen share. So let me pull that up as well.
Yeah, I think that just made it worse when I tried to zoom in.
And one thing I noticed with the GEX heat maps is, boy, you gotta make sure it's on the right date. I was looking at PayPal this morning and I thought this thing is so inaccurate, and then I realized, oh wait, for some reason it was set on a date from a week or two ago at that very top the top line there. So okay.
Yeah, I have seen that as well. I've noticed that.
Yeah, NVIDIA really, wow, looks like it could go up or down a few dollars, but it doesn't look too obvious. I'm just looking at it on another tab here. And that purple node over to the right, that 200 all the way out at what, March 20th, is a little bit north of us here, but not super telling. I almost want to zoom out more and see, am I missing something? Because I expected a little bit more information, which is okay, but it's almost like, are we going to see things light up or change drastically between now and end of day? That would be, so again, it's chasing the squirrels in the backyard or whatever. It's like, I don't know if I have time to keep an eye on GEX heat maps for NVIDIA all day. I'm not even trading NVIDIA at the moment, but boy, I'm really curious now. How's that going to play out, right? So we'll see. The brightest nodes for today are slightly above and slightly below where we're at. So really, we're either going to have a nothing burger, or this will drastically change, or it'll be wrong. It's got to be one of those three. So we'll find out in a little bit.
Absolutely.
Yeah.
Well, appreciate you guys. Just about an hour and a half here of your time. So we'll wrap it up. If you guys have questions, let's bring them over to the Discord community. But yeah, anyways, appreciate you guys being here. Zach, thank you for your time, as valuable as it is. So appreciate it, man.
Happy to do it. Yeah, appreciate you too. Thanks so much, guys. Thanks for chiming in. Really appreciate everybody that is hanging out here live or afterward, watching this later on. Thank you too. And hope to catch you on Discord or X later.
Awesome. Thanks, guys. Enjoy
bye for
the
now.
rest of the day. See ya.